You can't print copper, you can't code a silver mine, and right now the world needs more of both than exists on Earth. While everyone's buying AI stocks because ChatGPT writes nice emails, nobody's asking the question that's about to break the market. Where's the metal coming from? Because here's the thing they don't tell you in the tech pitch decks. AI isn't software floating in a cloud. It's a beast made of copper wire, silver contacts, and rare earth magnets. It eats electricity like a black hole. And we're about to run out of all of it. This isn't about going back to the Stone Age. This is about understanding that the future everyone's betting on requires more physical resources than currently exist in the ground. And the ones who smell this shift early, they're about to own the next decade. If you're watching this because you felt something change in the last 2 years, something the news won't name and your financial advisor won't explain, you're in the right place. Hit subscribe, because what I'm about to show you isn't theory. It's already in motion, and the window to position yourself is closing while the herd is still looking the other way. Let me ask you a question. Why are central banks buying gold at record levels? Not selling, buying, more than any year since 1967. You know what the official answer is? It's just traditional diversification, a hedge against uncertainty. Okay, let's accept that for a second. Now let me ask you another question. Why are they moving physical gold to Singapore? Not buying ETFs, not gold certificates. Physical bars, shipped, stored in vaults outside the Western banking system. If it's just diversification, why does the location matter? I'll tell you why. Because on February 24th, 2022, the United States and the European Union did something that changed the game forever. They froze $300 billion of Russian central bank reserves. Not Russian oligarch yachts, not private accounts, central bank reserves. The money a sovereign nation holds as its risk-free backstop. Gone. With a click. Now, I'm not here to defend Russia. I'm here to tell you what every other central bank on the planet learned that day. If you hold your reserves in the Western financial system, they're not really yours. They're permission-based, and permission can be revoked. China saw that, Brazil saw that, India, Saudi Arabia, the UAE, they all saw it. And here's what separates the alert from the asleep. They didn't panic. They quietly adjusted. No headlines, no announcements, just gold bars moving east and south. The predators don't telegraph their moves, they just move. That's why the gold is shifting, not because they think the dollar will collapse tomorrow, because they know the dollar is no longer neutral. And neutrality was the only reason it worked for 80 years. Now let's talk about something nobody's connecting yet. Artificial intelligence, the revolution, the future. The thing every portfolio manager is telling you to overweight. They're not wrong that it's transformative. They're just wrong about what it transforms. See, AI has a dirty secret. It's not clean, it's not efficient, and it sure as hell isn't sustainable at the scale we're building it. Here's the math nobody wants to say out loud. Training a single large language model consumes as much electricity as 100 homes use in a year. One model, one time. Now multiply that by 1,000 companies all racing to build the next ChatGPT. Then add the data centers. Then add the inference. Every time you ask it a question, that's electricity. Every answer, more electricity. Where's that power coming from? The grid. And what powers the grid? Copper. Transformers packed with copper. Transmission lines made of copper. Every EV charger, every solar panel inverter, every wind turbine, copper. We need to mine more copper in the next 18 years than we mined in the last 10,000 years combined. That's not hyperbole, that's geology. And here's the kicker. It takes 16 years to open a new copper mine. That's 16 years from discovery to first production. Permits, environmental studies, infrastructure, 16 years. AI data centers are being built in 18 months. You see the gap? Demand is moving at Silicon Valley speed. Supply is moving at geology speed, and geology doesn't negotiate. Now add silver to the equation. 50% of global silver production goes into solar panels and electronics. Not jewelry, not investment, industrial use. The same solar panels we need to power the AI boom. You can't print silver, you can't write code to make it appear. You dig it out of the ground, or you don't have it. And right now, we don't have enough. Here's where it gets personal. Right now, while you're watching this, the United States government just spent another $4 million. Not on roads, not on schools, not even on defense. On interest. $4 million every single minute just to service the debt. They're now paying more in interest than the entire defense budget, more than Medicare, It's the single largest line item in the federal budget. There are only two ways out of a debt spiral like this: default or debase. Governments never choose default, they always choose the printer, and when they print, your cash becomes the ink. Your 60-40 portfolio? 60% bonds that pay 4% while real inflation runs at 8%. 40% stocks priced at valuations that only make sense if interest rates stay at zero forever. That's not a portfolio, that's a trap. Because what they're not telling you is this: the only way to manage $35 trillion in debt without crashing the system is to devalue the currency it's denominated in. Inflation isn't a bug, it's the feature. It's how they pay you back in dollars that buy half as much. Gold didn't go from $1,200 to $2,600 because gold got more valuable. Gold is still gold. The measuring stick just got shorter, and it's going to get a lot shorter in the next 5 years. So where's the smart money going? I told you, Singapore, physical gold, central banks, sovereign wealth funds, ultra-high net worth families. They're not buying GLD, the ETF. They're not buying futures contracts. They're buying bars, taking delivery, storing them in territory they control. Why? Because they learned the lesson from Russia, and they learned another lesson from 2008. When the system freezes, paper evaporates. Counterparty risk becomes counterparty reality. If you own a gold ETF, you don't own gold. You own a promise that someone will give you gold if you ask for it. And promises break when everyone asks at once. Physical gold in a vault you control. That's yours. No counterparty. No click of a button freeze. Now, I'm not saying you need to move to Singapore. I'm saying if the people who built the system don't trust the system, that's worth noticing. Let's talk about the opportunity nobody's pricing in. Gold has gone up about 150% in the last 5 years. Nice, solid, boring. But here's what most people miss. Gold miners didn't go up 150%. The good ones went up 300%. Some went up 500%. Why? Leverage, operational leverage. Let's say a mining company pulls gold out of the ground for $1,500 an ounce. When gold is $2,000, they make $500 profit per ounce. Now gold goes to $5,000. Their costs don't triple. Costs go up maybe 20% to $1,800. Now they're making $3,200 per ounce. That's not a double. That's a 540% increase in profit per ounce. Same mine, same operations. The market hasn't priced this in yet. Because the market is still playing last decade's game, chasing software multiples and SaaS revenue. Meanwhile, the real asymmetric opportunity is sitting in the ground, quiet, patient, waiting for the crowd to finally look down instead of up. I'm not telling you to dump your entire portfolio into junior mining stocks tomorrow. That's gambling. But if you're sitting on 100% paper assets denominated in a currency that's being debased by design, you're not diversified. You're concentrated in the thing that's losing value. Here's the part that ties it all together. While the West spent the last 20 years building apps, the rest of the world built mines. Brazil has the second largest rare earth reserves on the planet. Why, an 80% clean energy grid, the farmland that feeds 1 billion people, the lithium, the copper, the iron ore. I'm not saying move to Sao Paulo. I'm saying this. In a world running out of physical resources, the territory with the resources becomes the new power center, and if your entire portfolio is US-denominated paper, you're betting everything on one territory. A $35 trillion in debt territory that's paying its bills with a printing press? That's not diversification, that's faith. Let me bring this home. We're not talking about the end of the world, we're talking about the end of a system. The Bretton Woods system ended in 1971. Most people didn't notice. 10 years later, the people who owned gold and hard assets were wealthy. The people who held cash got destroyed by inflation. We're in another 1971 right now. Most people aren't noticing. The dollar isn't going to disappear. It's going to lose its monopoly. The Treasury isn't risk-free anymore. Half the world is actively trying to de-risk from it. And the AI revolution everyone's betting on? It can't happen without a resource revolution first. And we're not ready for it. The herd waits for certainty. By the time certainty arrives, the opportunity is already priced in. So here's what you do. First, calculate how much of your wealth is in paper versus how much is in things. Not real estate you live in. That's a liability dressed as an asset. I mean assets that hold value independent of the system. Physical gold, commodity-producing businesses, resource-rich investments. If it's 90% paper, you're not positioned. You're exposed. Second, understand that diversification isn't owning 10 different ETFs. No, it's owning different types of value in different jurisdictions with different counterparties. Third, stop thinking like it's 2015. The rules changed. The game changed. The ones who win the next decade are the ones who see the new terrain first and adjust quietly. Here's your action step. Go to the comments right now. Type one word, physical or paper. That's where you're positioned. No explanation, no justification, just honesty. Because when the next freeze happens, and it will, the people holding paper are going to learn what the phrase counterparty risk really means. The central banks already moved. The sovereign wealth funds already moved. The ultra-rich already moved. The crowd is still buying the S&P at all-time highs and thinking their money market fund is safe. The question isn't what's going to happen. The question is, when it does, which side of the shift will you be on?